Hello and welcome. Thanks for tuning in to KYC. I'm Hersh Sayta. With me is Anushi Vakaria, and we're going to be speaking power today. We've covered a couple of themes on power. We've done power grid for KYC. We've tried to understand how transmission will work. But, you know, one of the other cogs within the transmission system and setup is, of course, transformers. And that's one of the key pieces within that transmission ecosystem. And today we'll talk a little bit about that space. Transrail Lighting is what we're going to be doing a KYC on today. And here's what I really want to know. One, I want to know how confident they are about execution. They have large projects, Anushi. Their book to bill is nearly 3 times, if I recall right. And therefore, is there a regulatory risk in terms of execution? Because you could see a delay in project both approvals as well as project execution from the vendor or the customer side of things, and therefore is that at all a risk is what I want to understand. Second, is there a people risk, because they've grown so quickly, so fast, and they're taking projects both on the transmission side as well, and now they're also getting into railways. So whether they have the capability, skill set, whether they're beefing up that skill set within the entity to make sure that they are capable of executing all that they are taking up. So that's the first thing. Second, how much of their top line is government linked? 55% is domestic, but how much of this is government linked, and therefore how dependent are they with regard to where the Indian government is concerned, and the ripple effect of that with regard to cash flow? If we quickly go to the next one, yes. So delays in cash flow materialization and the like. Also, there's a large short-term debt repayment which has built up over the last couple of financial years. I want to understand what that is. It's of course a good thing because it's a payable. So your payables have gone up. Whether that is sustainable, whether that's immediately payable, and the company has decent cash flow to kind of take care of that, or rather cash flow as well as cash balances to take care of that. But nonetheless, it's something that I want to understand better. Also, diversification on top line. They're doing this, Anushi, in a big fashion. How big are they willing to go on that? Will 90% plus still be the traditional revenue that they make from traditional sources is what I want to know. And what are the margins there? Will they dilute margins in any fashion from that 12%? At least the guidance doesn't seem to suggest so. Right. But how does that play out? Also, order book and growth runway. We all know that the opportunity is massive in this space, both in railways as well as, and more so in transmission. With that kind of opportunity, around 10 lakh crore is what I read, is the opportunity over the next 10 years. That's huge, and a lot of that could come to players like this because there aren't too many. And therefore, how is pricing and realization playing out at this point? Pricing has gone up substantially, realizations have gone up, and therefore you're seeing margins go up. But is that sustainable is the question, because are too many people building out from within is the other piece that I'd want to understand, and how do pricing and realizations go?
Also,
sorry, you want to add to something?
Yeah, just in terms of the last point, you know, the company did emphasize that it's the pricing which will continue to remain in focus, because even their order book, the way they bid, will be dependent on the factor in terms of where the margins are concerned. So that is something that we need to keep a track of on what the inflow growth is going to be for the future as well. Right?
Perfect. Yeah. But what I'm going to do is I'm going to hand it over to you for explaining what the company is about. So.
Okay, so we'll start off with the biggest business, the biggest vertical that the company has. Firstly, the company was incorporated in 1984, and it's a traditional power T&D EPC company. That is what we are looking at. That's engineering, procurement, and construction company. Now, it mainly focuses on the power transmission and distribution business. 93% of its revenue, or rather, its order book coming from this project from this vertical is what we are looking at. What exactly does this power transmission distribution consist of? It consists of galvanized steel structures for power transmission, along with the distribution that is there. It includes all the steps that we're looking at, which includes manufacturing, testing, installation, and supply as well of these galvanized steel structures. So that is one vertical that we are pointing out towards. But Harsh, you know, we also spoke about the railway. Railway is an opportunity that we should be watching out for.
Yes.
And in that, signaling is something that they do. So this is an interesting area that we are seeing. Around 5% of their order book stemming from this vertical is what we are seeing. It includes the likes of electrification, earthwork, and telecommunication projects as well. So interesting one to watch out for, right?
Yes, absolutely. So, then now they're also getting into civil construction projects. It's a very small component of the business, very frankly, but nonetheless, there is some amount of that which is playing out. You've got bridges, tunnels, elevated roads, and other civil infrastructure projects as well that they are taking up. But I'd be keen to know as to whether how much of that component are they willing to take up, and at what exact margin would they be willing to take some of these projects up at, because that's the more relevant part of it. Then there's poles, lighting, and projects which include high masts. It includes street poles, luminaries, power transmission and distribution monopoles, in all of this, it primarily operates in the Indian market. Some of this is already seen on your screen. So this is broadly what they also try to work around, and there's a very large market for it because there's just so much, so many highways that are being built where some of this electrification is needed. So all of that is necessary. But you want to take us through the order book segment?
So as the first vertical that we talked about was the power T&D that continues to dominate the overall pie that we are looking at. 93% is the pie that we are seeing of the order book breakup which is there currently. Railways on the next side we are seeing about 5% of mix from there. Is there a shift in terms of where the percentage is concerned in mix of these verticals is something that we should be quizzing the management for. Civil and poles and lighting, comparatively smaller mix that we are looking at, around 1.8% and 1.2% is the kind of size that we are seeing, right?
Yeah, and then you've got geography, 55-45 domestic to international.
Yeah.
Now, international has its set of risk because there's just so many geopolitical factors which are playing out at this point. There's also tariffs. How much of some of these moving parts impact the business is what we'd want to understand. Also Forex, because now you're suddenly Forex dependent. So, so some of those, we'll of course speak with Mr. Bagde and understand better as to what this company is all about. But let's quickly first break down the metrics as we always do on each segment of KYC. Let's quickly look at what metrics we'll look at. We'll start off with the income statement, the balance sheet, the cash flow, the return ratios, shareholding, street cred, street coverage, valuations, and outlook. We'll cover all of that. Street coverage is limited. Mind you, it's a newly listed company as well. So you want to keep your eye out on that. But very quickly, Anushi, as always, income statement.
Right. So it's a recently listed company is what we are looking at. It got listed in December 24. If you're taking the last 3 years in consideration, it's a consistent kind of a growth story that we are looking at in terms of where the revenue is concerned. 31% is the 3-year CAGR growth that we are seeing with FY25-24 also recording those strong set of numbers that we are looking at. But it's the EBITDA and the PAT CAGR wherein we are looking at a higher number in terms of where the growth metric is concerned. 49% of our EBITDA CAGR, while for net profit we are looking at a 72% of a CAGR. Do note that margins also have seen a shift from 9% in FY24 to 25, we are seeing 13% of a range. While the management has guided for a 12 to 12.5% of a range continuing, the question would be whether they can scale back to the 15% that was there a couple of years ago. That is something that we should be watching out for. But it's the order book also which is interesting in the company. Now, if you are seeing the book-to-bill ratio overall, it has remained in the range of 2 times to 3 times in the last 3 years or so. 14,551 crore is the FY25 order book that we are looking at. This is an uptick of a 44% compared to FY24 number that we are looking at, and this included order inflows of 9,680 crore, which is a 120% of a jump in itself. Do note that the company also had an additional L1 position of 1,364. In FY26 also they've declared some of these other key order wins. So as the current status of the order book is something that we should be updating the viewers with, right?
Absolutely. And so while the income statement is very, very impressive, here's why I don't find the balance sheet as impressive. You look at the equity, the reserves, that's all okay. No worries there. The book value also at around 1,800 odd crore, 1,900 odd crore. It's trading at 5 times book, by the way, just for information. No comments on that. Borrowing. And look at that number, 640 crore. Out of this number, it's actually essentially 600 plus crore is short-term borrowing. That's where a likely possible concern is. But they have enough cash and bank balance to fund that borrowing. So again, in that sense, it's not as big a concern. And therefore, we've given this a neutral. But I want to understand where this number goes in terms of the borrowing number. See, if it's a payable number, and likely it is, it's not that big a worry. But at the same time, I'd want to understand whether that number is sustainable or not, because working capital requirements have inched up sharply. The IPO was done for the purpose of meeting working capital requirements, and therefore, I'd want to know as to how the working capital cycle plays out. The receivables too are quite substantial on the balance sheet. In fact, let me quickly highlight that. Inventory of around 500 crore, receivables of around 1300 crore. Now, is this government-related projects, which is why this has ballooned, or how does it play out? And that has clearly played out on the cash flow as well, right? So neutral on the balance sheet, but cash flow, Anushi.
Yeah, cash flows also, I just wanted to emphasize on the same point that you were trying to make. While cash flows, we did see that 35 crore was the figure in FY24. 25, it moved to 287 crore, but it's the receivables which is a question over here. We've seen an uptick in terms of where the receivables and both inventory levels are concerned. Along with that, even payables is something that I want to question the management with. Why is there an increase in terms of the payables? So that's why we've given this a neutral rating on basis of their net cash flows. If we see, they are 32 crore as compared to a negative figure of last year. So that's the outlook on cash flows that we're building.
Well, on a side note, it's very interesting to see how each metric of the financials tie in with each other.
Yeah.
And at the end of it, they give us a great output. So for those really understanding financials, this is a great way to understand it. Anyway, let's quickly go ahead. Return ratios. When you're looking at the return ratios, there's been a steady inch up. The ROCE numbers are currently at 25% plus, in fact. So strong ROCE that the company has clocked. And despite this burgeoning working capital requirement, the ROCE number seems to be holding quite steady. So that's a big thumbs up, at least from our side. But shareholding, Anushi.
So in terms of where shareholding is concerned, now if you are looking at the promoter stake, 71%, and it's not a, so I just want to, while we are giving this a thumbs up, just want to emphasize on the point that we still do not have that much of a history for the company. So we just have 2 quarters of data since it's a current listing. So promoters continue to hold 71% of a stake in the companies. While if we look at DIIs, they hold about 14 to 15% of a stake, while FIIs minimal kind of a participation that we are seeing about 0.6% at the end of March 25, while public has about 14% of a stake. So we've given it a thumbs up on the basis of promoter holding and the DIs. Yeah?
Absolutely, yes. And also the fact that the promoters have left enough money on the table for investors, and that comes to street cred, right? It gives us a good perspective that promoters holding 71% is quite good. Whether the promoter dilution happens or not, we'll have to wait and watch, and we'll probably quiz management on that risk as well. But look at the way in which the stock has performed. Very few IPOs since last year have done what you're seeing on your screen, and therefore that's creditable that they've left good money and value for investors, at least the way we see it as of today. So that caveat in mind. You want to take up valuations and outlook?
Absolutely. So valuations remain attractive for the company. If you are seeing again now in terms of Transrail, if you look at the forward multiple, 22 times is the kind of multiple that we are looking at. This is in comparison with KEC and Kalpataru trading at similar levels. So basis on that, we have given it a neutral so far, but it's not something that we should be complaining about, right? Because it is on the attractive side that we are seeing. Skipper on on the higher side of 32 times is the multiple that we are looking at, but considering, we'll take more of these quarter performance in consideration to see how the valuations shape up, right?
Yes, absolutely. So we'll have to, of course, wait and watch as to how valuations shape up and whether this performance lasts, and we'll take views as well from the management. But let's look at the outlook. Neutral from an outlook perspective as well, overall. And street cred as well is, or rather street coverage as well is quite good. There are 2 buy calls. Average upside is around 14%, including 1 note coming in from AMSEC today morning. So a decent upside as well, which is getting built in. But what I want to really know is the outlook. And they've reaffirmed their EBITDA margin guidance of around 12%. They're looking at a 20+% growth guidance as well. I want to understand whether how confident they are with regard to that. Board has approved a capex plan of around 200 crore, and there's going to be a sharp ramp up with regard to products, and you can see that on your screen. From 84,000 MTPA, there's a goal to touch 196,000 MTPA. And on the conductor front, it's from 24,000 kilometers, more than doubling up. So very, very strong guidance both on capex as well as on the order pipeline and the growth going forward. Let's quickly sum up the ratings therefore, and let's bring it on our screen. We'll start off with the income statement. No complaints there whatsoever. The balance sheet we spoke about along with the cash flow, if you recall. The return ratios are quite strong at 25% despite the working capital requirements. Shareholding is a thumbs up, 71% owned by the promoters. Street cred, very, very strong. Good listing gains as well. And thereafter too, the stock has performed very, very well. On a valuation, it's largely a fair valuation, which is currently trading at basis FY26. And the street coverage plus outlook is also a neutral. That gives it a very healthy 6 out of 8 and no thumbs down as well with regard to where a Transrail Lighting is. So that one stands out. But let's quickly bring on board the chairman of Transrail Lighting, Mr. Digambar Bagde, who's joining us. Welcome, Mr. Bagde. Great speaking with you. I want to first start off by understanding how is the environment evolving in terms of execution? Is there any concern whatsoever internally as well as externally from a customer perspective on execution? Or is this just a problem of you executing and you building up capacity and executing and delivering to your customer? Give us that perspective.
Good morning. Thank you for this call.
Wishing you a very good morning, sir.
So first of all, let me tell you that we at Transrail Lighting Limited are proud to be one of the leading EPC players in India with very strong domain expertise in the power T&D. And over the years now we have diversified into civil, railways and poles and lighting business. So actually our strongest point is that we have our own in-house design facility, testing facility, manufacturing units and execution capability. So this end-to-end capability gives us the greater control over quality, cost and the timelines. So we are able to complete. So I try to address your first question regarding execution internally. Since we are controlling almost 70% of our supplies ourselves, that gives us the confidence to the customer that we are able to supply all the goods on time. And construction is again under our control. And there is a scarcity of skilled laborers in the market, but we are very well experienced since last 40 years in executing various projects up to highest voltages. So we are not faced much difficulty so far in executing, and none of our projects have suffered on account of shortage of laborers.
Okay, Mr. Bagde, this is Anushi joining in as well. And now you did speak about the execution pattern of the company, but want to emphasize more on the order inflows picture going forward. Now, last year we did see about a 120% of a growth in terms of where the inflows were concerned. If you take this year into consideration, you've pointed out a 1 lakh crore of an opportunity from which you can see about a 8 to 10% of a share, which implies about a 10,000 crore of inflow size is what we are looking at. Just want to get your understanding. Is that the kind of number that we should expect for FY26, or are you expecting for a higher growth?
So we can expect slightly more than what we have acquired the new project last year, because there is a huge growth in the domestic as well as international market. You must have seen from the CRISIL reports, they are projecting a growth of 7 to 8% CAGR and $20 billion of investment into the transmission sector. And also there is a huge investment in the other non-T&D sector also. So therefore we find that there will be very good order inflow in the domestic, not only in the domestic, but from the international market also. So we don't anticipate any degrowth or any kind of problem in getting orders or maintain our growth projection, what we have projected over the years.
Would the domestic to international mix broadly remain 55-45, or would that change?
Yeah, actually it will remain the same, more or less. It will be 50-50%. Now the order inflow, the domestic market also has improved substantially as compared to 2 years before. And of course, and in international also, we are growing into various more geographies, adding more countries. And I find there is a good order inflow pipeline coming from the international market also.
And so just on that front, if you can give us even a breakup in terms of how the margins differ in domestic as compared to international business, and some of the key areas in which countries are you seeing more of these orders coming in from on the international side?
So international projects are slightly better in terms of quality, because in terms of quality they are very good, because terms of payment, having a price variation, price variation, price protection towards the commodity rise, and also they are multilateral funding, so they are not depending on any uh, utilities or the government decisions. So they are actually funded. We choose the projects only if they are multilaterally funded. So that is one part. And in India also, we don't find any kind of, now since the projects are coming regularly, there is an improvement in the margins now.
So with that in consideration, can you see the margins? You know, you've guided for a 12 to 12.5% of a range currently, but in the next 2 to 3 years, can you see that going back to the 15% of levels? If you can give us more details on that.
No, 15% may not be possible, because you know that more and more competition is also evolving. So we will definitely try to maintain about uh, this year. Of course, we are given the guidance of about 12%. So I think that for next year also we can expect about 11.5 to 12% of EBITDA margins.
I want to understand when your fresh capacities go on stream, and does that mean that your capacity utilization will ramp up fairly quickly, or will it lag? Will capacity ramp up lag, or rather capacity utilization lag in some form or shape? Give us that color, because it'll help us understand growth visibility. That's where I'm coming from.
So we have seen that as the order book has grown, both in terms of T&D order book has grown. So therefore, there was a need to expand the tower and conductor manufacturing capacity. So this will definitely help us not only to meet up our project requirements, but also ensure that the future growth requirements also will take care with this enhancement of the capacity.
Okay, so that's in terms of capacity. If you can just give us in broad view in the next 2 years, 3 years, you know, once all these capacities, when is the peak kind of capacity utilizations that we can expect?
See, we had a capacity of 84,000 tons initially. And then when we increased it to about 125,000 tons, and we added a new factory, so that took us to about 175,000 tons. So that will take care of our existing order book. And for the future order, which we are expecting further growth, at least 20 to 25% growth, I can expect that about 22% growth in the next 5 years. Next CAGR is 22% growth in next 5 years. So therefore, we are actually keeping ourselves ready to meet up these challenges. And therefore, we have decided to enhance further capacity from 175,000 tons to 196,000 tons.
How quickly does that happen, sir? Date?
125,000 tons will be available by next 2 months' time, by
Oh,
say,
okay.
and we will reach up to 175,000 tons by March 26.
Excellent, excellent. And so, what would your capacity utilization be at that time in terms of percentage?
As far as the March 26th is concerned, you can consider about 95% capacity.
Wow,
Okay,
excellent.
yeah.
Okay, understood. And sir, with regard to cash flow, um, uh, it's been chunky, right? Is it only because of government projects? And will that continue to be chunky? What should we expect?
See, as far as these Indian projects are concerned, they are mostly the projects which are tendered under TBCB route. So they are not dependent on any government funding. So they are depending upon the funding to be arranged by the TBCB, that is BOT players. So we have seen that during last 2 years, while executing these TBCB projects, we are not faced any delay in receiving the payments. Only thing in the domestic market, there are dependency payments. So you are getting the payments against supplies, part payment against supplies, and then balance payment against erections. And therefore, the holding period of 20% retention is more than the international projects. Therefore, it is you will find that there is slightly increase in the data numbers.
And what about payables, sir? What's the status there? Because payables have also ballooned.
Payables are mostly these LC-backed players, payables, and we have actually planned it in such a way that the inflow and outflow matches. So therefore, we are opening the LCs and 180 days credit LCs, 120-day credit LCs. So therefore, you find that the numbers of payables are more, but they are actually matched with the collection cycle, so that there is no cash flow problem for the execution of the project.
Excellent. Sir, thank you so much for coming and speaking with us. This is indeed very, very insightful, both from an industry perspective as well as from a company perspective. But viewers, thank you so much for joining us. Completely out of time from Anushi, myself, everyone who puts this show together. Thanks so much for watching. Stay tuned to NDTV Profit. More action on the other side.